Welcome to Oregon Cash Flow Pro. My name is James Barber. I'm here to help you maximize your cash flow. Today we're going to go over the comparisons between the L95 and the L99. And this is going to be pretty detailed as far as the numbers go, because the products themselves aren't really that different from each other. So what we're going to look at the performance of the two and how they compare. We've got a 35-year-old male. We're going to do a few different scenarios, one where he makes maximum payments for 7 years and then base premium payments from then on. We're going to do reduced paid up after those 7 years. I'm going to show you how the guarantees work on each of those products and where those break-evens happen. And then we're going to look at how far does each dollar go when you put it into that policy when it comes to cash value growth. We're going to look at it in percentages and actual cash differences. So there's a lot of detail coming up. I hope you're interested in seeing a little bit more about this. I'm going to put the spreadsheets up near the beginning of this video so you can pause them and go over them if you want to without having to sit through the whole video. But if you're interested in hearing my take on it and as I describe it, stick around.
Oregon Cash Flow Pro offers free money management advice to help you take control of your finances. And now here's your host, personal finance enthusiast and licensed insurance broker, James Barber.
First, let me show you the scenarios that we've got coming up. So remember, this is a 35-year-old male. I'm going to show you each scenario, and then we're going to go over what's going on in each of those. So you can see right here, this is our L95. We've got a $2,000 base premium, which means we can put in 10 times that amount for 7 years based on the death benefit that we put into this policy. So that means $20,000 for 7 years. After that, it's going to be the base premium plus the small amount of paid up additions. So $2,000 base premium and $400 for paid up additions. We're going to pay those as long as we can. Okay. Then we have scenario number 2, which is Guardian's L99. Same scenario, $20,000 for the first 7 years, $2,400 after that. So we're going to be comparing apples to apples with these policies. Next scenario, we've got Guardian's L95 with the reduced paid up after 7 years. You can see we've got the cumulative net outlay, net cash value, and our death benefit. Now this first scenario set is all going to be based on non-guaranteed values. Our non-guaranteed values assumes that there's going to be dividend payouts, okay? And those dividend payouts are going to match 2020's dividend payout. Next scenario, we've got Guardian's L99 with a reduced paid up after 7 years. You can see it looks just like our last one as far as the layout's concerned. Then I compiled them into this chart where it shows our net outlay compared to our cash value for each year for each of these policies. So it starts off with the L95, the L99, the L95 reduced paid up, and the L99 reduced paid up. And going through here, you can see when this drops below 100%, that's when we hit our break even. So right here, L95, we've got our break even year 4, break even year 6, break even year 4, break even year 6. It's kind of neat to see those numbers like this. And next one is very similar to the last one. We have the same 4, but I show you an actual cash value, what those percentages mean. So we can see when we have positive numbers here, this is our outlay minus the actual cash value. So in the first couple of years, we have a positive here because we put out more money than we put into it. So in this case, we like to see these negative numbers. This means that our cash value is greater than what we've put into the policy. And you get to see this all the way down through year 65, which is age 99 for this person. Then I move on and I'm going to show you our guaranteed values. So this is the guaranteed values for L95. You can see rather than putting in 20,000, this is if we set up the policy like we're going to contribute the max amount, but then for some reason, you just contribute the minimum every single month. How is that going to look? And I'll warn you now, it isn't pretty. Then we'll go over the same thing with our Guardian L99. And then we'll show you what is the guaranteed when you actually fund it, how we're expecting to fund it, and how that performs. Our guaranteed values means no dividends pay out, and there's maximum rider charges on any riders that are associated with the policy. Now, the way we design these, we're actually not including any extra riders in general because we're trying to streamline and just go for cash value only. There are riders that you could put on these policies like waiver of premium, but for the most part, if you're funding these heavily front-loaded like we're doing now, those riders are not really needed. There's a very slim possibility that you could use them in the future, and really those riders will fund the base premium, which we have set at a very, very low amount. And often we're going to reduce pay up these policies anyways at some point when we're done making those premium payments. At that point, none of those riders are going to be in effect anyways. So these policies are really streamlined for cash value growth, and we're going to see how these guarantees look. Then we've got the guarantees for Guardian's L99 product. So we'll be able to compare how that looks next to the L95. And yes, this keeps going. I put a lot of work into getting these put together for you guys, so I hope you appreciate this. These are the same numbers for the guaranteed policies, and we'll be able to compare these to the non-guaranteed values as well. But clearly the non-guaranteed values are going to look a lot better. As you can see briefly, our break-even periods are a little bit shorter when we're actually funding it, but when we don't fund it, when we just minimum fund this policy, look at how far down our break-even period, 43, 44 years out, 35 years out. That's a long ways. These policies are not meant to be minimum funded. But you're going to see why with actual numbers to reflect it here in this video today. And then here's that same thing, but in actual dollar numbers, not percentages, so you can see exactly when it breaks even. Here you can see where it goes negative in year 6. And these ones, the numbers grow up until about year 20 before they start to drop. So moving down, you can see it's not until year 34 for one of them and year 44 for the other where we finally get to the negatives, which means we've passed our break-even point. Anyway, that's a quick sneak peek. And then we're not done yet. And then I'm going to finish up by showing you this index universal life illustration with National Life. And this one's funded at $7,000 a year because, like I say, when we're looking at these index universal lives, I view them as Roth IRA replacements. They work very well in replacing your typical retirement vehicle. And so funding it's a good idea to match the funding with what you normally might do with your retirement account on these types of policies. So we're going to be able to see how that performs as well. So I know this is a lot of data coming your way, and I hope to make it a little bit easier for you to understand what we're looking at, because it's 10 times harder trying to do this by looking at the actual illustrations. So the reason I put them in the spreadsheet is so that you can understand more easily how these numbers work together and how to compare one policy to the other. Because when you're flipping back and forth from one page to the next with PDFs or if you decide to print out a 40-page illustration and you can do it on paper, it's still not quite putting them side by side, and it's just not the easiest thing to understand. So as with all of this channel, my hope is to increase transparency in all of these products, how they function, how they grow, and so that you can understand how to use these products in order to maximize your cash flow. Okay, so let's dig into this just a little bit more. I'm going to put these up side by side. We've got Guardian's L95. Remember, these are our non-guaranteed values. So these are assuming dividends, which we can typically assume that we're going to earn some type of dividends, since Guardian has paid out dividends for the last 150 plus years, every single year. Okay. While we illustrate guaranteed values and non-guaranteed values, I tend to focus more on the non-guaranteed values because Guardian is a really good company. They're ran really well, and they're always one of the top performers when it comes to paying out dividends. And there's no reason at this point to think that that is going to change drastically. So with that in mind, we've got our net premiums. We have cumulative. Let me show you, highlight these things. We have net premium. We have our cumulative net outlay, our net cash value column, and our death benefit column. So you can see right here, I have these green highlights. This is our break-even period where our cash value passes our cumulative net outlay. Okay, so comparing this to Guardian's L99, where we have the same payout, you can see our break-even period here is in year 6. Okay, and our cash value surpassed our cumulative net outlay. What else can we glean from looking at this? You can see in these early years how the cash value of the L95 is greater than the cash value of the L99. And that goes all the way up until year 14. At year 14, now it suddenly switches. And you're going to start generating more cash value in the L99 product. So the slight design difference in these, your L99 goes to age 99, your L95, your pay premiums until age 95. Whatever that slight difference is, behind the scenes, you end up with longer term, higher cash growth in the L99 product when you keep paying the premiums past year 14. So prior to year 14, if you're going to turn it into a reduced paid up, you're going to be in a better financial position going with the L95 product, at least with this particular client. It may be different with other clients, but year 14 is about when that's going to flip. Let's scroll down and we'll see how does this look down here at age 99. You can see we've put in $267,000. Our cash value is $1.572 million. Our death benefit now matches that. These policies are designed so that your death benefit matches your cash value at age 99. And then we see here in comparison our L99, you can see we've put in $276,000. That's about $9,000 more, almost $10,000 more than we put in the L95. But our cash value and our death benefit are about $80,000 higher. So quite a bit difference for a small amount, but clearly we have better performance in the L99 product under this funding scenario. Okay, now we've got our L95 with the reduced paid up and our L99 with reduced paid up. Okay, we're going to pay $20,000 a year for 7 years, and then we're done. So you can see our cumulative net outlay stops at $140,000. Remember, on our previous slide, our cumulative net outlays continued to grow until we got up to $260,000, $270,000. So we're going to see lower values overall, but we've put in quite a bit less money. Now let's see how that works out. As far as our break-even periods, those stay the same. That doesn't change because remember, we're funding this exactly the same way as we did the other one. So we're still looking at break-even period of years 4 and 6. This one's really close to breaking even in year 5, but it didn't quite make it. And cash value, how does this end up? When we get to age 99, we have 140,000 into the policy, 1.2 million cash value, 1.2 million death benefit. And on the L99 side, look at this, 1.196. So it's lower. So remember, I said, if we're going to turn these policies into a reduced paid up prior to 14 years, you're going to see higher cash value in the L95 product. So let's look at what this means in percentages for each year and actual cash difference. This is our non-guaranteed values again. You can see these are each of the policies, and this is our percentage numbers, and these are our actual dollar numbers. As you can see, we've got our break-even periods right here in year 4, where it goes from positive to negative, and again here in year 6 for the L99 products. So in year 1, I'm going to focus on the dollars. If you like to see the percentages, you're welcome to take a look at those ones. But you can see here in year 1, cash value difference. I don't want this to be confusing, but what we're looking for is we want lower numbers, okay? So we see a bigger number here in L99, which means there's a greater difference between what we've paid in and what we see in cash value in these early years. That's not on the side we want to be on. We actually want to see it get closer to negative and then that negative number grow as far as this goes. I know it's a little bit confusing. I probably should have shown it the other direction where it's negative on top, but bear with me. Maybe in a future video, I'll flip that around. So what we've got in the first year, you've got about $60 extra cash value on the L95 product. Year 2 now, we've got almost $1,800 extra cash value. Year 3, so I'm looking at the differences here between these numbers. Year 3, we're almost $2,700 difference. Year 4, $2,800 difference. Year 5, $3,000 difference. So see, the L95 in these early years is really starting to outpace the L99. We're going to obviously see that catch up here soon, but let's find out when that happens. Here in year 6, we're down to, or we're still right about $3,000 difference. Year 7, $3,000 difference. Year 8, $3,000 difference. I mean, these are approximate, they're varying slightly. Year 9, we're just under 3,000. Year 10, we're back down to 2,700. Okay, it's going to start to catch up now. L99 is going to start to catch up. Year 11, almost $2,400. Year 12, 1,900. Year 13, 1,300. Year 14, less than 1,000. We're about 600 away. And year 15, we finally surpass our L99, takes the lead by about $100. And then we get to see a difference from there. Now, these are on the policies that are not turned into reduced paid up. If we look over here on the next 2, where we're looking at the reduced paid up policies, if we go down these lines, you can see that it doesn't ever catch up. Let's keep going. We're still ahead, still ahead, still ahead by year 37, and all the way down at the bottom, we're still ahead. We got about $24,000 more in the L95 product than we do the L99. And on this side, where we don't do the reduced paid up, we keep putting money in every single year, we end up with about $74,000 more in the L99 than we end up with in the L95. Pretty neat, and yes, I kind of geek out on this stuff. It helps if your agent knows how these perform so that they can make sure that they're putting you in the best product with the best design that's going to meet your funding needs. Moving on. Now let's look at the guaranteed values. We're expecting the client to put in $20,000 a year for the first 7 years. In this scenario, that client falls on their face, tragedy happens, for whatever reason, they can't make the payments, but they do make the bare minimum payments each year, okay? Odds are, if it's that bad, they'll probably just cancel the policy and that would be okay. If for some reason, though, you're starting a policy and we design it like this and you're planning on minimum funding it, don't even start the policy. I would really recommend we can find you a different product. We can design it differently. Don't jump into a product like this designed this way, okay? So this is bare minimum. This is the guaranteed values. If you don't put any money into it other than the base premium, and it's not pretty. So we're gonna scroll down. You've had a chance to look at this one. There's no break-even periods anywhere around here. Okay, we're still, by year 20, we're still 11,000 on the wrong side and 9,000 with the L99. If we make it all the way to year 35, which would be age 69 for the L99, you've made it to your break-even period. Good job. And if you make it to age 78 and you're putting in that minimum, you finally reach the break-even period on the L95. So yeah, these numbers are not pretty. Believe it or not, some people buy policies that are designed like this, like they're just really bad, or they fund them this way, and it's just not good for the client. Going all the way down, eventually what happens is your death benefit gets eaten into. You end up with, you put out $120,000. You have a slight amount of cash value by age 99, and your death benefit is slightly more than you've put into it, but you are not in a very good situation. And same thing with the L99 product. You put in a little bit more, $128,000, and you've still got $157,000 death benefit if you can live to age 99. So I warned you, it's not pretty. Let's look at some better guarantees. Okay, if you actually fund the policy as anticipated, means we're putting in 10 times the base premium for 7 years, and after that we'll do the base premium. You can see we still have a break-even period of year 6 in the L95 and year 7 in the L99. We've got our years over here on this side now. So that's pretty good when it comes to guarantees. Remember, our non-guarantees are assuming we will have dividends. The guaranteed values assumes no dividend payouts, maximum charges on the policy. So at worst, if you're funding this policy as we design it, you're going to hit that break-even period within 6 or 7 years. Some of the policies out there, like, that's part of their best design that they offer you. You know, 6 or 7 years is where they want you to hit that break-even point. On a bad design policy, you might hit a break-even point in year 14 or 15 or 20, and those are years that you start off with no cash value. Well, look at these cash values. You have guaranteed in year 1, you're going to have 17,000 and change. Clearly, it's going to look a little bit better on the L95 product, but we're expecting that. And down here by year 14 and 15, we're going to see this L95 surpass by just a few $100 right here in year 15. We're going to see this L99 surpass the value of the L95. And long term, the only issue with these guarantees long term is that we're continuing to see this high cost of insurance on the side here. What happens is we're using annual renewable term insurance to get up to the original death benefit. And so as you get older, the cost of this term insurance gets very expensive. And eventually, when that cost goes way up, you start to see it eat away at your cash value. And so that's what we're going to see happen down here at the bottom of the screen. As we get closer to age 99, this cash value is getting eaten up. And then suddenly, by age 95, 96 or so, you've got to start reducing that death benefit because you're not going to have enough money to keep paying for that high of a death benefit. And with the L95 product, even with this guaranteed cash value, it does happen in that very last year. You end up with a lower death benefit. Remember, these are guaranteed values. The guaranteed values will simply not be hit. It's never going to show up that way. We know that for sure because when you start your policy, Guardian has already declared a dividend for that year. So by next year, this guaranteed scenario is already going to be higher because you're going to receive a dividend that first year, which will surpass the guaranteed values. Okay, next scenario, I put all of those guaranteed cash values into our chart that shows you based on a percentage how much you've put in. This one comes up with an error because it's zero cash value in the first 2 years if you're minimum funding it. You can see up here I say minimum funding or maximum funding, so we know which ones we're looking at. These red and green mark our break-even periods for those products. And over here we've got actual cash values. What does this mean in dollars? Remember, positive is not good, negative is good. We want high negatives when it comes to this separation. It's outlay, how much we've put out, minus the cash value, okay? And for the percentages, I did outlay divided by our cash value. That gives us these percentages, okay? So let's go all the way down on these guaranteed values, and we can see we've finally gotten into the negative on some of these, but they do turn positive right at the very end. Remember, we had that cost of insurance that was just enormous, and so it was really eating into any cash value growth that we had in these policies. So in a real life scenario, if this was your policy, you would not continue to have that $750,000 death benefit. If we had these guaranteed scenarios and we saw that it was hurting your cash value growth, we would reduce the death benefit. We may even eliminate it or turn it into a reduced paid up policy, as we've seen in the previous examples. If we turn it into the reduced paid up policy, we could end up with over $1 million at the end of this. Whereas if we don't turn it into a reduced paid up policy, we can keep paying for whatever the death benefit is, and it may end up where if we have to rely on the guaranteed values, things aren't going to be good. But that's because that term insurance is connected to it. So really what we would look at doing is getting rid of that additional term insurance. I did not illustrate that on this, but that is a possibility. As we go through this in real life, these are decisions that you make year to year. You don't have to keep these death benefits going if you don't want them. You don't have to keep premiums going if you don't want them. We have a lot of different flexibility. You can put more money in on 1 year and less money in on the other years. So we're a little bit limited on what we can illustrate on these and what we can compare. And we're basically just showing you worst case scenario and best case scenario. But there's all this point in between that it could actually be as well. So things to consider when we're looking at designing your policies. And finally, to finish this up, let's look at this IUL policy. Remember, we're using it as a replacement for a Roth IRA type of retirement vehicle. So we're looking at putting in $7,000 a year. These are the non-guaranteed values. This assumes a 6% growth in the S&P 500 because the way the IULs work, you get the growth of the stock market, but you don't get the losses. So an overall average of 6%, I think it's a fairly conservative outlook on what we can expect for these policies. Obviously, it's going to depend on the performance of the stock market, which we have no idea how it's going to do in the future. We can only look back and use what we've seen in the past. And we have 120 years of S&P 500 growth to compare. So while it might be fairly safe to assume if we end up in a Mad Max type of future, then obviously everything goes out the window. And I don't know I don't even know how to advise you on anything with money in that situation, at least at this point in time. So what we're going to assume is we're not going to have that type of a future at this point. We're going to assume that the stock market will continue fairly close to what it has been in the past, and we're going to assume that 6% growth. At $7,000 putting in each year, we're looking at a year 4 break-even period. You can see our cash value, accumulated cash value, and our cumulative net outlay was surpassed. Now this column here, this is a new column that you didn't see in any of my whole life videos. This is the surrender value. What that means is in the first 10 years, if you were to cancel this policy, there's going to be a surrender charge. So the amount that's available in your policy is actually less than what the total accumulated value is. Now, you are going to have this accumulated value growing in the index options of your choice, or at least a large portion of that. Some of it gets set aside for the basic costs, and that part gets held in the fixed index portion of the account. But the rest of it gets put into the index options of your choice. So the surrender value is really just how much cash available to you if you wanted to close the policy. Now these are designed, and the way we look at them is as retirement vehicles. So we're planning on making payments until about age 65, right? I mean, we're assuming we're going to make payments until we retire, and then at some point we're going to start pulling money out of this to use in our retirement. So what I did on this one was we stopped it at age 65, and you can see our surrender value and our accumulated value are the same as it has been since year 11. We have a nice hefty death benefit to go along with it. And if we go down here to age 99, if we haven't taken anything out of it, you can see we've put in 217,000, and wowzers, we've got quite a bit of cash value growth. So this is quite a big difference from what you see in a whole life policy. That's because that's the potential of utilizing that extra growth in the stock market. The guarantees on these products are not good. So you're not going to want to put large chunks of cash into it that's not normally reserved for retirement type savings. That's what we use our AND asset for. That's what our infinite bank is for, okay? You can use these products like an infinite bank. Don't let these numbers get the best of you though and fool you into thinking you should just put all your money in them, because they're not guaranteed. Like, we cannot stress enough the importance of having those guarantees behind you. The guarantees on these policies are atrocious because the caps could go very low, the indexes could not perform, your cost of insurance could go up. There's a lot of different variables that happen with these, okay? So it's very important that we understand that we do have some risks going into it. The risks that it takes away is losses in the stock market, which elevates this type of product above. It's a heck of a lot safer than actually being in the stock market. But there's quite a bit more risk than being in a product like our whole life product, as we illustrated on those earlier ones. So one of the things that I did not illustrate for you, which I will have to do an in-depth one on that, is the index option that Guardian offers. It's the only whole life company that offers that index option where you can get market-like growth. It functions similar to the IUL, only it has much, much better guarantees. The only difference, I mean, the only thing that I would say is it doesn't produce the same type of returns. You're not going to see $4 million at the end for this same design that we have with this IUL, mainly because the cost of insurance is not based on annual renewable term, which is very cheap when you're young, but the insurance costs are still based on the whole life costs. So that's one of the big differences there, but I will get into that in a different video. Hopefully you found value in this one, and I hope you enjoy scrolling through and seeing the numbers. And if you have any questions about them, put them in the comment section below. I'm happy to answer. And if you found value in today's video, hit the like button, subscribe to the channel, and follow along on this financial journey with us. If you want to see more like this, or you want to learn more about the infinite banking concept, check out these videos over here. We'll see you next time.
Now go maximize your cash flow.